Hello and welcome to the Astranti Guide to BA1. Today we're looking at Chapter 4 and this chapter is focusing on price, demand and supply. As part of this chapter we're going to start by looking at the market and get a better understanding of exactly what that means. We're then going to move on to look at demand and supply and finish up by looking at the equilibrium point. So without further ado, let's get going. We've got some friends here, Simon and Luke. Now Simon and Luke have decided to set up business together selling strawberries at a local market. They booked their pitch, bought decorations and containers for the product and got some aprons as well. But when they were due to make their first appearance at the market, they suddenly got a little bit worried. Do they have the right stock? What price should they sell it for? Will there even be any demand for strawberries at all? All these questions take us into the realm of demand and supply. Hopefully we can find the answers to these questions for Simon and Luke. But firstly, we need to understand the idea of markets. Let's start by giving ourselves a quick definition of what the market actually is. Technically, a market is a medium through which buyers and sellers of goods or services come together to trade. But there are two different ways we can understand the word market. One way is in the physical market which Simon and Luke will sell their strawberries, or the literal gathering of buyers and sellers. However, there is a more abstract notion of the market. This refers to the potential for trade. For example, is there really a market for strawberries in Wimbledon during the summer? Well, yes there is. To break down our definition of market even more specifically, we can identify four broad categories of market: goods markets, factor markets, commodity markets, and financial markets. Goods markets are markets where finished goods and services are traded. For example, the punnets of strawberries that Simon and Luke are selling. Factor markets, in comparison, are where the factors of production are traded. The factors of production are land, labour, capital, and entrepreneurship. For example, one of the key factors of production is labour, and so an individual's labour is traded through the job market. Moving on to commodity markets, where raw materials are sold and bought. For example, gold, steel and ore would all be traded on the commodity market. And finally, our financial market. Our financial market, or stock exchange, is one that trades in shares and loans. For example, the London Stock Exchange. So who's doing the selling and who's doing the buying? We need to consider B2C and the B2B marketplace. When I say B2C, I mean that the trade of goods goes from business to consumer, and when I say B2B, I mean the trade of goods goes from business to business. Now, in general, suppliers are companies and buyers are households, so the exchange of goods and services operates from company to household. This is known as business to consumer. Luke and Simon's stall would come under this heading too, as they're a business trading to the consumers who want to purchase their strawberries. However, some companies sell to entities such as to other companies or government authorities. This is known as a business-to-business marketplace. For example, if Simon and Luke decided to start selling their strawberries to a local restaurant, they'd be selling to a business, so they would be operating in a business-to-business marketplace. So we've given ourselves a really good understanding of the market now. But let's go back to Luke and Simon. The first day of the market has come around for Luke and Simon and they're very excited to start selling their strawberries. On Monday morning, they decided to sell their strawberries for £3 per punnet. But by 11 o'clock, they'd only sold 3 punnets. Panicking a little bit, they decided to drop the price to £1.75, and business did improve quite steadily. High on the success of their price drop, they dropped the price even further to £1.50. And by the end of the day, all of the punnets of strawberries had been sold. Now, when Tuesday came around, they decided that they would start the price at £1.50 per punnet. After all, following yesterday's disaster of a morning, their experience suggested that this was the right price at which they would sell all their stock. But is this the right choice? To answer this question, we'll need to look further at the concept of demand. Now, put simply, demand simply refers to how much people want something, but we are going to need a little bit more of a technical definition. Economists view demand as the extent to which consumers are willing and able to purchase a good or service at any given price over a set time period. We say able in reference to whether the consumer can actually afford it or not. For example, 10 million households might be willing to buy a seat on the Virgin Galactic into space, but only 1,000 households may be both willing and able to buy a seat. Therefore, the economic demand is quantified at 1,000, not 10 million. In Simon & Luke's case, although there were a lot of customers in the market, at £3 the strawberries did not sell. Not enough people were willing to pay that price, so demand was low. However, at £1.50, a lot of people were both willing and able to purchase the strawberries, so they managed to sell out of their stock. Let's move on to the demand curve. The demand curve maps the relationship between price and demand. The general assumption is that as price increases, the quantity demanded of the product or service decreases. For example, at £1.50, Simon & Luke had lots of sales, but at £3 they had no sales. Or only 2, I think. But enough talking about a demand curve. Let's have a look at one. This graph shows us a demand curve for small family cars. From this we can see that as price increases, demand decreases. For example, when a car costs £10,000, only 60,000 cars are sold in that year. However, when the price drops all the way down to £6,000, the demand shoots up to 80,000. This is because of the law of demand. As we've seen over there, as price falls, quantity demanded increases. This means the demand curve is pretty much always downward sloping, as there is an inverse relationship between price and the quantity demanded. This inverse relationship simply means that as one increases, for example, the price goes from 6,000 to 10,000, the other variable decreases. So the quantity demanded goes from 80,000 to 60,000. So we've got a really good understanding of how an increase in price results in a decrease in demand. But why does this actually happen? Well, economists like to say that this is because consumers look to maximise their total satisfaction, known as utility, from scarce resources. Put simply, we just want to get as much joy out of spending our income as possible, our income being a scarce resource. We haven't seen that word utility, so very quickly I'm just going to explain that utility is simply the measurement of the amount of satisfaction or enjoyment that a customer gets from consuming a given good or service. In simple terms, as the price rises, we believe we're getting less value for money, so less enjoyment and satisfaction for the amount we're paying out, and we're therefore increasingly unlikely to buy it. For example, at £1.50, customers are getting sufficient satisfaction and enjoyment from the strawberries to part with their money, but at £3 they are not. An alternative way to think about this relationship between price and demand is in terms of opportunity cost. An increase in price increases the opportunity cost of buying that good. By that we mean the individual has to give up more in comparison to other goods services they could buy. At Simon & Luke's market, at £3 people would prefer to spend their money on a big pack of bananas, a large coffee or a pair of socks. But at £1.50 that's only a small pack of bananas, a small coffee or one sock. And so it seems better value. The opportunity cost is lower. So now we understand what the demand curve shows and how it operates. But there are some other things we can learn from the demand curve. We can see here we've looked at 2 separate points on the demand curve, at a price of £10,000 and at a price of £6,000. Movement between these points would be known as a shift in the demand curve. This is where we're going to talk about extension of demand and contraction of demand. Extension of demand is an increase in quantity demanded as the price has fallen. A contraction of demand is a decrease in quantity demanded as the price has risen. Let's look back at our graph. So an extension of demand has happened where there is an increase in quantity demanded from 60,000 to 80,000 as the price has fallen from £10,000 to £6,000. By contrast, a contraction of demand has happened where there is a decrease in quantity demanded from 80,000 to 60,000 as the price has increased from £6,000 to £10,000. So the demand curve can really tell us a lot. There's one more thing we can find from the demand curve as well, and that is the level of consumer expenditure. We can find the level of consumer expenditure by multiplying the quantity demanded by the price. We know that when the price is £10,000, demand is at £60,000, so the consumer expenditure is £600 million. When the price is at £6,000, the demand is 80,000 units per annum, so the consumer expenditure is £480 million. Even though demand has increased, at a lower price the consumer expenditure is actually lower. So surely that covers everything we could possibly know about demand and we could find out from the demand curve. Or does it? There's one more thing we need to cover, and that's two different types of demand. Demand can operate at the level of the individual and as the market as a whole. For example, we've already discussed how demand is the extent to which consumers are willing and able to purchase a good or service. Let's say at £3 per punnet, Bob would buy 5 punnets of strawberries a month, whereas at £2 he'll buy 7 a month. However, there's a similar demand curve for the total demand in the whole market, and this is called aggregate demand. When we discuss aggregate demand, we mean the extent to which consumers are willing and able to purchase goods and services across a whole economy. For example, at £3 per punnet, 1 million punnets are sold in the country as a whole, whereas at £2 per punnet, 1.5 million are sold. There's a lot more we can learn about aggregate demand, but we're not going to look at it now. It's just something you need to be aware of at this stage. So we've understood everything we can about demand and the demand curve, and we've especially discussed how as price increases, demand decreases, or generally how price can affect demand. However, in addition to price, there are a variety of factors that can affect the demand for a particular good.